Hello, welcome to another edition of Nucleus Investment Insights. Apologies for being away for the last couple of weeks, and this week wanted to run through economic tipping points. And so I guess the big issue that you see everywhere in the markets and from all sort of fundamental investors is the predictions of doom and some serious economic problems. In the meantime, we have markets sort of bouncing back, sort of up 20% off their lows, and this real disconnect between the two. And so what I want to really focus in on today is, what are these economic tipping points, and why haven't we seen significant downturns yet, and what are the things that could lead us to seeing some significant downturns. So just a reminder that everything you hear today is general advice in nature. None of it is personal advice. If you do want to get personal advice, then give us there's contact details in the show notes. You can book yourself in for a meeting, and we can talk about personal financial situation. So so let's sort of jump into this sort of overall thought around why have we not reached this why have we not reached a tipping point, and what are the things that could actually take us there in terms of markets? And I want to frame this discussion in terms of a number of different ways to look at this. And now I'll start at sort of the higher end of the level, which is what's the broader strategy within Trump's process of and what's actually sort of what's driving a lot of the changes and a lot of the policies. Now, there's a whole bunch of theories out there. It's obviously very difficult to come to any one scenario, and we do have our own sort of internal. I guess I want to talk about what our own internal model is for it at the moment. But there's a run through sort of 4 different versions that you see out there, and then the 5th one, which is what we think is sort of a mix of them. Now, the first one is that Trump is all knowing and all seeing, and he's playing 4D chess, and everyone else is playing checkers, and in a few years' time, we'll finally work out what the beautiful plan was, and we'll be amazed at how great it was. Now, I'm going to rule that one out for the moment. Maybe he is. It's obviously we can't see it if it is. It's not sort of the type of mayhem you've seen, and the competence of the people he's appointed don't seem to be part of a master plan. But maybe that's just us. So we'll move on from that one. There's the most common criticism I think you see of Trump, particularly in liberal media, is he's just a narcissist. He's got a short attention span, and the net effect is he's just winging it. Whatever happens to catch his fancy of the day, that's what he's going to run with, and that's going to be his economic policy. And indeed, we've sort of seen several cases where he's been sort of, I guess, caught out with questions where they've asked a question about something, and he's given an answer, and that answer wasn't the same as his prior answers, but the next thing you know, he's doubled down, and that's his new policy. And so the idea that he says whatever he feels like, and then he decides whether that's going to be that's it. So if that's the case, and you're an investor, if that's it's obviously a very difficult investment environment, and I think that's what you certainly see out there as saying, well, okay, therefore the whole thing must fall apart is sort of the definition the conclusion you get from that from the investment perspective. The second version is it's sort of similar to the first, but it's basically saying that, look, he's narcissist, he's got a short attention span, he's winging it and everything like that. So, but he has got a bunch of advisors behind him and a bunch of people who donated a lot of money. And so what really matters is what they want and who's driving the show in terms of the people behind Trump in terms of that. Now, that's got its own problems in terms of if that's the overall view about, and because you hear these stories about all these tariffs come out. Navarro's been the main one in driving these tariffs, and he doesn't like Canada, and all these issues about why that's the case. And then you've got sort of Besant and Lutnick waiting until Navarro's out of the room, and then grabbing Trump and convincing him to backtrack on the tariffs because it's destroying the economy. And so if this is true, and what we really care about is the advisors, then it's almost just as much problem as the first scenario is in that we need to worry about we need to know who was the latest advisor to speak to him and who's got the most power. And 2 or 3 months ago, you would have said, hey, Elon's the man. He's everywhere. He's popping up. Musk is in all the different cabinet meetings that he should or shouldn't be in. And he's the one really driving this in terms of the policies. Fast forward a few months and he's out the door, and he's calling Trump a pedophile, and Trump's talking about taking away the contracts from SpaceLink and all these other ones. And so you're sort of stuck in that same scenario of, look, what can you do as an investor when you sort of if that's the case. But let's not put that completely aside just yet. The other one, Scott Galloway, sort of a professor's sort of come out quite in the last week or two and sort of pushing the theory is actually all that matters is Trump's just in it for the grift. He just wants to make as much money as possible. The corporate governance and laws and all this type of stuff don't really matter. All that really matters to him is just making money. And whether it means that accepting a jet from the Qataris worth 500 million, whether it means that he's building golf courses and Trump towers and all these things in all these countries that are trying to suck up to him or trying to get deals, that's what he cares about. And actually, if you look through it, you need to look through the broader trend of what he's doing as he's just in it for himself, and he just wants to make the maximum amount of money. So you sort of got these three, and so that's probably a bit more of a there's more investment stuff you could hang off the back of that, I think, in terms of if that was the view. Our take is that it's a bit of a sort of natural selection game between the prior three. So we've cut out that 4D chess version and said, okay, we're assuming that's not happening, and if he is, then we're wrong. But it's this idea that, look, there's a certain amount of narcissism, there's a certain amount and short attention span and just winging it. There's a short of there's part of it is being manipulated by advisors, and which of the advisors that have the upper hand is important, but not necessarily the most important thing. And then yes, he is interested in the grift and making money, whether it's crypto or these other factors. That's what's that's what's going to drive him. Is a lot of it is his own personal wealth and how it affects that. But the bigger, but if you, there's also this overlying factor on this, what we're calling sort of the natural selection of these, is that Trump's just throwing stuff out that and seeing if it sticks, and how much pushback he gets. And it's the idea that, yeah, look, I'll accept a $500 million plane from Qataris, and I'll see how much pushback I get. And if the pushback's not strong enough, well, I'm taking it. If the pushback's too strong and I think there's going to be too much pain for it, well, okay, I'll drop it. So who cares? Let's move on to the next grift. And I think there's a certain amount of this which is, falls into this. Where's the pain? Is it the stock market? Is it a pushback from his own supporters? Is it, I think pushback from liberal media he's not particularly concerned about. Pushback from courts. I think he's a little bit. Certainly lower level courts he's not concerned with. I think he's more concerned with the Supreme Court, and we'll see what happens if some of the bigger decisions start going his other way, because I think maybe there's an idea he might just push back on those as well. But yeah, so I think the idea that there's this phrase out there called TACO, which stands for Trump always chickens out, and it's the trade that basically whatever he does, assume that he's going to chicken out of it and flip back around. And I think there's a bit of truth to that, but I think there's a certain it's this idea about how much pain, and so he's going to push forward with things, and he's certainly willing to take a reasonable amount of political pain and dissent from particularly liberal media sources he doesn't particularly care about, but I think that's sort of the core sort of driving philosophy behind this is it's throw a bunch of things out there, see what gets pushed back, and the stuff that doesn't get pushed back as hard, that's the stuff he's going to sort of hone in on. Okay, so that's our sort of overall picture for how we're looking at this. And it's a relatively positive picture, to be honest, from an economic point of view, with the view that, look, he's just going to, the overall factor says, okay, he's just going to keep trying stuff, and the stuff that markets like he keeps, and the stuff the market doesn't like he throws away. And there's a certain, whether there's a long-term benefit for these, you'd probably say no on most of the cases. But short-term, it's this idea of running up the credit card while you're, there's a certain amount of, shift to companies. He's going to be shifting money effectively from governments to companies. And it's the idea that, yeah, he's fully on board with the Besant plan until it comes to the fact that, actually, maybe it might, it might actually affect the economy and it might be a slowdown. And so he's on board with that, but he's not on board. But he's then going to push through a bill that's going to increase spending rather than decrease spending. And he's sort of picking and choosing. Here's a bunch of good things and a bunch of bad things this thing's going to do, or a bunch of here's the pain it's going to take, and then here's the benefits, and he's going to try and go, well, I'll have the benefits, but I'll pretend I'm going to take the pain and then push back on it, or reverse it at the last minute. And so so with that lens, that sort of gives you a much more positive economic outlook, and it also means that some short-term pain the economy might be going through over the next 6 months or so because of all the backs and forth and everything on tariffs. Well, maybe that's maybe that's quite limited, and markets can look beyond that if they think that he's just going to pick and choose the stuff that is economically positive and skip around the negative stuff. Okay, so that's our broad overview of how we're looking at this. I'll just go to a quick sales message, then I really want to jump into where the problems are and what can go wrong with this.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
So I'm going to start with the environment before I get into what are the tipping points and what are the things that can go wrong. I just want to sort of frame the US economy and in a sense, some of it a lot of it sort of flows through to most of the developed world. Given the US economy is the largest part of that, is that we're looking at a particularly strong, or certainly stronger than many people expected, US economy that Trump inherited. So it rolled through a lot of things that people thought were going to cause recessions or certainly economic slowdowns, and it just didn't. It's sort of it was much stronger on the wage growth, much stronger on employment, and yes, there was certainly an inflation problem, but that inflation problem's largely gone pre-Trump. Some few final remnants of it, but most of it was sort of out of the way. And so there's this idea that there's this you're starting at quite a strong point in terms of economic growth. Then you add in Biden left the fiscal taps turned on pretty hard. There's lots of going into debt, so government spending money, and for the large part that's a transfer from governments across to private companies largely, as opposed to if you sort of think about the economy as being your government part, your businesses and your households, is that households were getting some decent wage growth, government spending lots of money and going into debt, and the corporates are the ones that are sort of the net beneficiary of that whole system. So we've got that. US has had great productivity growth. So we've spoken a few times on this about how bad Australia's productivity growth has been, but the US productivity growth, they've got the opposite problem in that they're trying to work out why is productivity so strong, as opposed to Australia, where we're trying to work out why is it so weak. So that's great. Wage growth's been quite good. And then you roll through the future, and there's AI stuff popping up all over the place. That's probably productive. There's questions on whether it's ready for game time yet, but certainly in some applications it is. There's certainly productivity gains that can be got through there. We've got driverless cars we've been speaking about for a while. They're up to a sort of a quarter of taxi rides or ride sharing, in San Francisco and growing to other markets. That's sort of like another productivity gain, given that's a huge employer of people and a huge sort of cost center in the US. The weight loss drugs are certainly helping. We've seen that starting to tap out in terms of the obesity level in the US has stopped rising. And that's sort of, we think about that as you're dragging your anchor. If every year, 1% more people are obese than what it was the prior year, there's all these extra costs in terms of your healthcare system and other factors that are flowing through. Whereas if that stopped rising, you're not dragging the anchor anymore. And at some point it might even start falling. It's a sort of big productivity gain for the economy, not having to spend money on that. And then robotics, and there's other stuff going on, which is automation stuff, which is productive for the US economy over the next sort of 5 to 10 years. And then the other factor is US energy costs are quite low relative to the rest of the world, and so renewables helping at the margin, but if you've got really low gas costs, which the US does, then you're starting with this sort of energy benefit relative to the rest of the world. So quite a strong outlook over the next 5-10 years in terms of that. Now the question is, can Trump's stuff knock that off course? And what are the things that can knock it off course? Now I've got a sort of dozen things that are out there that where there's issues that are important to sort of keep factoring in. But the broader message is they're really confusing, and not confusing just at an economic level or investment level, but confusing for people on the ground who are genuinely affected by these. And many of them are the reporting systems we have just aren't going to reflect what's really going on at the ground level. So what do I mean by that? So let's take the inventory cycle as a good example. So the inventory cycle is this idea that when sales at the sort of retail end, when that falls by 10%, then the wholesaler has 10% of extra goods, and so he actually he sees his sales. So let's say he's selling 100 per quarter, and now you go down, drop, and you only sell 90. Is that the wholesaler now has 110 sitting in his inventory because he didn't sell 10 from last time, and then he only needs 90. So when he puts he's only expecting to sell 90 again. So when he puts his order through, he's actually only ordering. He's not dropping his order from 100 to 90. He's dropping his order from 100 to 80 to sort of bring him back into the 170 to bring him back into the right thing. And then the next person down, or the next person down on the manufacturer, has the same issue. They've got all this stuff on board, and so the manufacturer, the person sort of sitting on the end, has a massive effect in terms of this inventory cycle. And so they might be cutting their sales might be dropping by 50% in the month, and then it's the bullwhip effect, and the opposite happens on the way up when people start to reorder. So what's happening with the inventory cycle? Well, the inventory cycle, we had this really strong push in the first quarter as companies are all trying to order, pre-order to get in front of the tariffs push, get these things what they could. Then it stopped dead. So ships stopped coming from post Liberation Day. Ships stopped coming from China. We hadn't really actually seen the effect of that because the ships had stopped, but there's this sort of big hole in the ocean, so to speak, where the ships just hadn't even left China with the goods. But companies had probably received enough to get them through. But so you went from really strong to a really weak inventory cycle. And now we're actually back to a really strong inventory cycle, because as soon as the tariffs were like, okay, it's not 100 and something percent on China, it's back to 30%. There's been another strong ordering push around the part of, well, okay, he's pausing it for 90 days. It's no longer going to be, well, it's back to 30%, but it's probably, there's a reasonable chance it's going to be higher than that. And for a lot of companies, at 100%, their businesses were dead. And so, they needed to push in this big set of orders as well to get them through this next part while they start trying to find alternatives to China. So what does that actually mean? Well, it's going to be really hard to read. And sorry, the other factor over this is that inventory cycles really vary between different industries. So some inventory cycles are very short, measured in days or weeks, and other ones, measured in months, and other ones, you're talking in quarters or longer in terms of the, how long ahead you have to order. And so that whole inventory cycle on, off, on again is going to be confusing in terms of reading statistics for I don't know, probably the rest of the year, in terms of what's actually going on at the real sort of underlying economic level. So could that be a tipping point? Could we see that something really blow up in that inventory cycle? Yeah, maybe. So that's sort of one we sort of need to keep an eye on. The next one is this idea of the capex hold up and sort of this cease in capex as these tariffs are on and going and off again. You're building anything, you probably need stuff from China. You don't know whether I start breaking ground today on building a factory or a building or something like that, or let's say it's a factory, break ground and building it. In 6 months' time, I'm ordering I'm putting back on back order power systems or robotics or something. There's stuff in there I'm ordering that's coming out of China, and do I know what that's going to cost me? Do I either buy it today and be outside the cash flow or assume that I'm going to get all the approvals and all these other things I need to get through, or do I wait until I've got through those and run the risk that I might be 120% tariffs at the end of it? And so when companies are trying to sign off on a business plan to say, okay, this factory is going to cost $100 million, is like, well, it could cost 100 million, it could cost 150, it could cost 80. We just don't know what the environment's going to be when all this happens. And so that sort of led to this real capex freeze within that. So is that going to make an effect? How damaging is that going to be within the US? That sort of flows through into consumption as well. Is that what's happening with the consumption and inflation? Are we looking at if the inflation? We know we've got some tariffs through, and so prices are taking a bit of a jump. Walmart's putting its prices up sort of 5-10%. Does that end up leading to people spending the same amount of money but buying less goods, or do people actually have to shell out more for this? So what does that mean in terms of chances are it's probably a bit of a mix of the two, but it's at some level people are buying less stuff or changing. I'm not going to eat out as much because I need more for groceries or things like that. So there's this whole what's happening in terms of US consumption. On top of that, you've got some of the tourism factors. So tourism seems to be dropping a fair bit into the US. Is this just a one-off sort of short-term factor of while Trump's trying to make Canada the 51st state? There's a bit of a backlash, and Canadians are not taking holidays to anywhere to the same extent in the US. But in 6 months' time, that'll just wash through and it'll all be forgotten and we're on with life again. Or is there a fundamental, underlying change to that in terms of that tourism numbers? And seeing tourism from around the rest of the world as well is certainly falling, and some of the some of the factors behind checking people's Facebook pages or social media just to get into the country and other factors like that might be scaring people off from visiting the US as much as in the past. Plus all the students in, students out, and all that type of stuff. Is there an economic hit from that? And the answer is maybe. It's probably, but is that, where does that sit in terms of the offset? And what is that doing in terms of how much weakness do we see? Is it just a little bit of weakness that hits this strong economy and so it all washes out in the end, or is that enough to sort of to knock it off kilter? And obviously each of these could be additive in terms of all these factors. Then you get through, if you're talking stock markets and investments, the idea that, well, I'm actually not investing in small companies in the US. It's mainly large companies, or not, it's exclusively large companies. And there's a big difference between how some of these policies are affecting small companies versus large companies. So one of the issues is, say I order $1 million worth of widgets. I'm sitting in the US, order $1 million of widgets from a factory in China. They're probably going to give me 90-day terms usually. And so I place my order, I get the widgets, they arrive, I stick them on the shelves, I sell half of them and use that to pay back the $1 million that I ordered it for, and then I make my profits or whatever from the rest of it. So that's my business model. Now with these tariffs, I've got to pay extra up front. So when it hits the shore, I've ordered $1 million, hits the shore, I'm going to come up with $300,000 worth of tariffs in order to get the goods at all. So for a large company, trade finance, they might have other, they've got capital available, or it's possible to get, and they add on some extra, you up the price a little bit to pay for the interest costs and and you're off and running, and so probably doesn't even affect your margins. As a small company, though, you just might not even be able to get that finance, or you're mortgaging your house, or whatever it is. There's problems around that. So there's probably a push towards larger companies, and if you're going through this period where sales falls a little bit, say, but there's a shift from small companies to large companies, well, maybe the large companies actually end up, sales might not even fall, or you might even fall by an insignificant amount. And so there's those issues around maybe earnings don't get affected as much as what the economic effect is. So broader economic effect affects small businesses, but not large companies, which are the listed ones we're investing in. Also, a lot of the listed companies are global. Like there's sort of 40-odd% coming from international earnings, and so there's just a smaller proportion of their earnings that's being affected, relative to smaller companies as well. So maybe the effect on large listed companies, where we're seeing the stock market moves, just isn't as much as what the broader economic effect directly on US companies might be. Worker shortages is another factor. So we're talking, there's obviously a big crackdown on illegal immigrants in the US. Where does that lead? Well, it leads to worker shortages, but it also leads to higher wages. And so, there's a plus minus on that. The people that are there are still going to be getting, or the people that remain are probably going to see better wage growth. There's also an issue for statistics and what we're seeing in terms of wages. So, say you're a factory, or whatever, you run a business and you've got 20 workers working for you. 15 of them are on the books, and 5 of them are illegal immigrants and whatever, getting paid in whatever method they end up getting paid. Maybe all this crackdown means, okay, I've actually, I'm going to cut myself back to 19 workers, but I can't find as many, people to as many illegal immigrants to do it. Maybe I'm going to get 3 of them, so I actually I need to go and hire one more person on the books. So now I've gone from 20 workers to 19 workers, but actually, in terms of what's on the books, I had 15 workers before. Now I need 16 on the books because I'm down on the undocumented workers. And so from an employment point of view, maybe the employment numbers actually end up looking better. And so there's this idea within the US is that, well, what you're expecting to come from an economic point of view might be a drop in employment, but what we see in the statistics is the opposite, despite the fact that there might actually be a genuine drop in employment out there. So so where am I coming to from that? That might see us end up with higher interest rates. So the Fed not cutting rates as much as if they did see sort of weak employment, and just means that it's this whole idea of the muddied waters. The same with what was talking about the inventory cycle and this capex hold up and large companies versus small companies. Is there's just a lot of stuff going on, a lot of moving parts within this. It's going to be very difficult to try and work out where the actual signal is coming from versus the noise. So it's a worker shortage. I'm going to go to one more quick message before I've got a whole bunch more of these that I'll sort of run through as well.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So then we were talking about the higher interest rates and what the effect of that is. So again, this is something probably going to affect smaller businesses more than larger businesses. There is this issue, sort of an overlying issue in terms of, is that enough to knock off, some of the less financially strong companies off kilter? Maybe there's certainly a lot of private equity as well that's sort of come up over the last 5-10 years in the US. Been huge growth in private equity, and a lot of that is very much debt funded. And so the question for those is, is there enough in terms of the higher rates in there to start knocking some of those business off kilter? And could there be a domino effect in there? Yeah, absolutely. Housing costs as well, given that US really runs off that 30-year mortgage rate, that this could certainly slow the building of new houses and that demand for new houses down. You've got a lot of people in the US sort of locked in and with much lower interest rates, and so not wanting to change or move houses. So yeah, lots going on in that phase, any of which could sort of knock this whole thing off kilter as well. So that's sort of one more factor that we're watching, and I think the private equity one for us is one that probably isn't as well recognized. I think if you're talking about what could go wrong in terms of debt markets and borrowing, there's an element of the commercial property. But look, we had a commercial property scare a few years ago, and it's rarely the problem that everyone knows about. So I've had this commercial property sector scare. Banks are sort of fully aware of it. There's we had some banks fall over and some other issues going on there. I think that they've now had 2 or 3 years to sort of raise equity or sell down the more troublesome components of that. Not to say everyone's safe, but it's unlikely to be like this massive come from nowhere. Nobody expected it, and everyone's got too much exposure to that area. Whereas private equity could be one of those areas we think that that just far too much debt in that one area. Next one, supply chains. So obviously lots of changes within supply chains. I'm not as concerned about this as being a major source, and partly for that same reason I was talking about with the commercial property is, look, we had a major supply chain issue during the COVID. Companies spent a lot of money on supply chains. They went from being something that CEOs just didn't even know anything about during COVID, in terms of questions and queries about why, what are the other problems, and where does this supply chain come from, and what could go wrong with it. In 2020 was a thing CEOs they've been used to for 20 years or 30 years. The supply chain just worked, and they didn't need to worry about it as a business function. Then they did, and it was really crucial to know, right, exactly where are our weaknesses, where's all this stuff coming from, what are the problems. So I do think this whole tariffs problem with supply chains and things changing things around won't be anywhere near as much of a problem as it was last time. Not to say it couldn't happen, particularly if you ended up with sort of 100% plus in China and sort of a complete shutdown of US versus China. But I don't think it's going to be something anywhere near as what it was post pandemic. And given the supply chains as well, and particularly in terms of costs, one more area that small companies versus large companies makes a huge difference. So if I'm a small widget maker and I've been ordering everything from a factory in China because I wanted to get economies of scale, and maybe I'm ordering $20 million worth of stuff every year and selling it in the US. Big tariffs and higher tariffs on China. I've got to flip to somebody else, flip to a different country. Very difficult to do, and very difficult to sort of change and manage those costs. Whereas I've got to go to a new factory in whatever, Indonesia or Vietnam or somewhere else and build up a relationship and convince them to take my my $20 million worth of orders. Whereas if you're a large company, you're probably dealing with much larger orders, but you're also probably already a bit diversified in terms of, I've got maybe 50% of my stuff comes from China, but I've got a factory in Eastern Europe as well, and another one in Malaysia and something else in Thailand. And so maybe what I end up doing is my Chinese stuff used to all go to the US. Well, now it doesn't. Now my Chinese stuff goes to Europe, and my European production goes across to the US or whatever it is. It's moving things around to avoid these tariffs, and you've just got the scope to do it. Whereas whereas your smaller companies generally don't. And so that's that whole part about maybe for some large companies, and certainly some that I've we've been looking at and talking to management, is that they actually expect that they can do those types of things, and if prices go up, which they look like they are going up, they think that might even be margin positive in terms of what they're getting out of this. Is that, they managed to put their prices up by 8%, but actually their costs only go up by 4 or 5%. And so, that's small versus large again, and that whole idea of supply chains. There's an overall factor about, the Trump is quite comprehensively purging US institutions, and I think there's a reasonable loss of knowledge at a lot of the regulatory levels. Now, that's great on one front for companies because lower regulations probably means higher profits for a lot of companies, and they're still sort of benefiting from that. There's this idea about what's too much and what's too little. So that Trump's talked about doing the Fed next, and then markets pushed back, and then he decided he wasn't, and that sort of comes back to our idea that he's throwing all these ideas out, and when one of them gets too much pushback, he seems to be happy to drop it. But maybe at some point that won't be the case. If the US economy does get weak, it is quite possible he'll the Fed will be the next. He wants to. They might not want to raise lower interest rates because of inflationary issues. And stronger employment, he might be quite keen for them to do that, and so maybe that's the next step where he starts to jump in and make some serious changes there, which could then be another tipping point to sort of to lead markets further down. There's this idea that so if you removed a lot of the safeguards, probably good for the short term, bad for the longer term, but how much does that matter to markets right now? And if there is, say, you remove Consumer Protections Board was one where gone through and gutted it, and that was something that was set up sort of post financial crisis to ensure that you wouldn't have another financial crisis. So does it give us the possibility of another financial crisis going forward? Absolutely. There's these issues, and what could it be? The thing is, it's probably not short term. These things take a while to build up. And so, and almost by definition, you need a bit of a boom beforehand before you end up getting the crash later on. And so, again, it's one of these factors that, is this great policy, and is it something that's going to benefit long-term growth? Probably not. Is it something that's going to benefit short-term growth? Yes, probably will. And could it lead to some sort of tipping point? Yes, but the tipping point is probably a fair way away. But something to keep an eye on as well, particularly if he starts moving in on the Fed. I think there's you could see markets react and push bond yields up and cause some issues in terms of that. There's an overall factor as well as, is the US moving into some sort of, whether you call it a kleptocracy or what matters is not, how good your business is, but really how close you are to the president. And so if you're Apple and you've given them lots of money, and so when he's talking about tariffs, you can turn up to the Oval Office and get him to sort of roll it back so that, yes, there'll be these tariffs, but maybe it won't affect iPhones. Or you can, you're an Elon, and probably a better example is you're an Elon Musk type character, and it looks like it's great for you first, and then you fall out of favor, and now it might be terrible for you. And that whole idea of, look, is it just your relationship with the government? That tends to be quite poor for setting up new companies and people wanting to take risks and entrepreneurial spirit of the US economy, which has really been a key to it, which is this idea that, and you've seen this in China, is this extraordinary growth in new companies. And then as Xi started his crackdown on companies and imprisoning various tech execs and taking away their businesses and all that type of stuff, that level of growth dropped off quite dramatically. And so could that be a tipping point in the problem? Absolutely. Again, it's one of these ones which is a short-term, probably not a short-term issue, or it's a short-term minor issue, and the issue is sort of longer term in the next sort of 5 to 10 years where you see that main problem happen. So that's that part. There's this idea as well of reflexivity around the taco trade. So the idea of the taco trade is that if Trump's always going to chicken out, whatever he announces, markets react, and you just take the opposite position. And the issue with this is Trump came out and was quizzed about this and hadn't heard about the term, and quizzed about it and clearly didn't like the term at all. And was affronted that people think he's always chickening out. And so there's this idea of reflexivity, which is, when things happen, maybe the things that happen actually affect the next one and the next one along. And what I'm talking about here is that there's this whole behavioral economics and prisoner's dilemma, so to speak, in terms of this, where you're sort of playing chicken with the markets, where Trump takes an extreme position and markets go, well, he's just going to reverse it so we don't have to worry about it. And so maybe that means that Trump then keeps that position because, well, if markets haven't reacted, I'll just keep the position. Or if markets do react, he's like, well, this time I'm not going to, I don't want people think I'm chickening out. So this time I'm going to hold firm. And so there's a whole idea of, is there something that could blow up because Trump just takes a weird position? Markets at first assume he's not serious about it. He doubles down. Markets then, once they start reacting, he then decide, well, I'm not going to chicken out on this one, and that's something that causes a crisis. Absolutely. What could that be? I don't know. And so, we have to sort of watch and find out around that. Okay, so that's sort of these broad, and there's more out there as well, but that's just a broad thing. There's sort of a dozen different factors out there that you can watch in terms of what could blow up, what could go wrong, and what could go right. And there's a bunch of questions out there I just want to highlight as well. I will get to these questions, once I've sort of reached the end of this. The capstone to all of this, though, that I want to sort of drive through is there's this extra tipping point. Sorry, there's this extra factor which sort of sits over this whole thing is maybe Trump has created so much confusion, though, that actually the individual parts of confusion don't really matter. And so what do I mean by this is that when you've got one or two things to focus on, so say it's tariffs, say there's a tariff on China, one tariff on China. I'm a producer. I'm reliant on China. That's the only factor. I can base my business, and I'm not going to hire, or I'm not going to do this. I'm not going to build a new factory because I've got this concern about China, and I think this is what's going to happen. And so, therefore, I can, make my assumptions and move on. But say I'm that same businessman, and I've got this issue where I don't know whether the tariff's going to be 100%, 30%, 0%, 10%. It could be anything. I don't know. I've got no faith in what Trump's going to do, and so I've actually got no idea what I should be doing. I'm also worried that maybe there's maybe it's kleptocracy, maybe it's not. Maybe he's going to, one of our competitors have made a large donation to me. He's going to put me out of business because of that, or maybe I've made donations, and so I think I'm fine. There's what's on, what's off. Supply chains, maybe my supply chain is going to get stuffed up. Higher interest rates, housing loans, are they going to be lower or higher? Or is there a worker shortage? Isn't there a worker shortage? Is a wages going to be up or they're not going to be up? But is there going to be extra inflation because of these tariffs? Is there not going to be extra inflation because of the tariffs? I've got global company issues that are going to affect me positively or negative. Is there this reflexivity of the trade? Have we got riots and National Guard's being called in? Like, there's just stuff going on everywhere. I don't know what's going on. I've got no idea. It's obviously chaos. But if there's chaos, well, maybe I'll just, the best thing to do is just what I always do. Whatever I did last year, I'm just going to do it again. And you know what? Whatever happens, happens. I'll just have to work it out when it actually happens. And I'll have to work out when, and I'm not even going to react if he announces something, because if he announces something, then, the courts might reverse it or whatever. I just need to focus on, this is just my business. I've just got to do it, and I'll see what happens. And so maybe that's where a lot of the US actually ends up it's almost we've had so much complexity and so much chaos that the end result is, well, maybe things don't slow down as much as what you might have expected. And maybe it's just that, people just go, well, I'll see what happens and I'll soldier on and then wait to see what's happening. And I think that's where this whole, the whole overview is that, look, there's a lot of things that could go wrong and really a lot of things we've got to watch out for, because there is some pretty serious negative downside we could get from this. But you're in this case where maybe the chaos is enough that you've got this ultra strong US economy going along. It's going to get hit by all these minor factors, but because there's so much chaos, maybe it doesn't get hit anywhere near as hard as what it might if there was only a couple of factors. And so maybe there's, it's enough for a bit of a slowdown. And because you're investing, if you're investing in stock markets, you're getting large companies, maybe there's enough benefit from that small to large switch. And Trump's obviously they're going to run the economy pretty strong. And if you took the view that, look, he's going to throw a bunch of weird stuff out there, but he's actually going to keep the ones that are market friendly or that he doesn't get much pushback on. And you don't get much pushback usually when you talk about spending more money or giving more tax cuts. And so maybe you end up with an economy that's largely where it is today. It's not particularly strong, but it's not particularly weak, and so it all sort of washes through. And so so that's my sort of overview. Is that, look, can see lots of downside, can see lots of problems and things that might go wrong, but if it's all going to be culture wars and fighting about do we have calling in the National Guard for a couple hundred people in California and that's what the keeps news cycles going and all that type of stuff, then economically and from an investment point of view, that keeps churning along. And so I guess where the concerns are for markets in particular is if Trump's not out there, if he's more focused on mucking around with the internals of the world economic system, then there's sort of cause for concern. When he's just fighting culture wars and talking about doing all these massive cuts in Doge, but actually not delivering on most of what he says, and talking a big game on all this stuff, and arguing about whether he should accept $500 million donations from Middle East countries or not. That's where markets can sort of go, it's not a great thing, and it's not great for corporate governance and all these other factors, and bad for the future growth in at the margin, but it's not affecting current growth in any meaningful way, not sending it into recession at that point. So there is an investment point. What do you do from an investment point of view? But let me get a couple of questions first. Anything regular people can do to prepare for possible economic changes? For this, from Ethan. I think it's to have a reasonable amount of cash on hand to take advantage of economic downturns if we do see them. It's also being nimble at this point and saying, okay, look, I do need to keep into fact that maybe there's any one of those factors I spoke about, plus there's probably another dozen factors out there I haven't spoken about that could tip this thing off course and could send it into recession. But it's I don't know if you can bank on any one of those coming through. And so you want to have enough cash that you're sort of comfortable, but still have enough invested that you're not that when markets rise, you're taking part in that whole rise. There's where are we? Do I think the Australian economy can bounce back quickly if things go wrong? Look, it really depends how much China is affected and how much China's going to throw at it. I think there's, you need to keep in mind that, look, the Australian economy is effectively really just at the moment a household, housing prices and a second derivative of China's economy. I don't think the Labor Party is looking like doing any major changes in terms of their policy. It looks all very much, just keep things going and hope it's all fine. Australia's sort of got this issue that you've got the US fighting back to say, well, we don't want to be this country that has these there's massive imbalances in terms of running up debts while and just not having a manufacturing sector. We want to try and reverse it. And what that means for a country like Australia, who hasn't taken that position, is that we just end up with more goods dumped on us from other countries, and a weaker manufacturing sector. And so we just sort of tilt our economy even more to financial services and resources. And so that's fine in the short term. Resources I don't have a great confidence in. Financials are expensive in Australia, extremely expensive, and relatively low growth given how much debt we already have. But can I see imminent disaster there? No. And so for Australia, it's prefer not to have an Australian exposure. But much prefer to have international exposure, but it's it's a question of where that getting the right thing with the Aussie dollar and avoiding sectors in Australia where I don't think they're going to be we're not facing a positive environment. Ant is asking whether we're doing enough to protect from future economic shocks, or we're behind the curve. Look, I think we're behind the curve, absolutely. I don't think I don't think we are prepared for future economic shocks, particularly in Australia. But we've sort of relied upon other countries stimulating to get us out of these factors, and it's worked pretty well so far. So who am I to complain? I think there's certainly Australia's economy is vulnerable, given how we've built it up, but it looks like the current government is hell bent on building it up even further in terms of cutting the deposit rates for first home buyers, pushing the housing market into even more of a bubble. We're probably going to see lower interest rates as we get flooded with these extra goods, and we're going to see a weaker manufacturing sector, and we're just going to tilt everything. It's a replay of what all the things that got us to the position we're in at the moment. That it's going to keep replaying until it's clear they can't, and that could be some time away. So so that's sort of the overall factor that sort of fits in. The question is, what are we doing from an investment point of view in this? Look, keeping a reasonable amount of cash on hand for any of the pullbacks is important. In terms of stock selection, for us, it's very much about trying to find the quality companies within these. And so what do I mean by that is that there's different types of companies you have in different for different environments. So there's this idea of what do you call a momentum trade? Whatever's going up is what I'm buying. Whatever's going down is what I'm selling. Look, it's a dangerous trade, that one, at the moment. You just never know what policies are coming out, and if that's what your trade is, you got to be focused, hell-bent on Truth Social and what's the latest from Trump in terms of whether the momentum trade's on or off today. So that's a tough one. The other three major sort of sectors that people sort of look at, the way they look at it is you go, well, I try and buy growth stocks. Now, these are stocks that that are usually quite expensive, with the view that if the markets are going up, they'll go up by more than markets. If the markets go down, they'll go down by more than the markets. So your high risk sort of part of the thing. I spoke about saying, look, there's sort of more limited upside to markets, and you can see some big downsides if things go wrong. So that growth area of the market, if markets keep rising, they're going to go up the most, but I think the downside risk is not worth it on that front. On the value stocks, so these are the cheap stocks where you can, the idea that, can I buy, if I'm just buying cheap stocks, do I get protection? Well, the problem with cheap stocks is they generally don't have a lot of margin control. And so if I've got a stock with a 3% margin, it's whatever it is, a tire manufacturer or making bricks or whatever it is, some sort of commodity product that they really don't have a lot of control over, is that a tariff in the wrong direction could decimate that business. Whereas if you've got something with a 50 or 60% margin, tariffs aren't going to be great, but it's not going to send the company into a loss or potentially, put it out of business, and push to another country. So the companies with the high margins, companies without as much debt, more stability, they're the ones sort of we're trying to focus on in our portfolio. Phil uses his chance with the volatility to buy quality companies when they're down. And I think that's the main way you sort of need to look at your portfolio as to how you're going to get through that. So that's I guess that's all I really wanted to say on the topic. Thanks everyone for tuning in. You can get our research from the website. You can jump onto nucleuswealth.com and register there to get emailed out everything we're doing every week. If you want, you can. Sorry, I need to put up the wrong one. You can get this. You get the Nucleus every Thursday, 12:30. You can get us live. If you do want to ask any questions, you can use that opportunity to ask questions. We're on all the major platforms in terms of podcasts, Spotify, Apple, all that type of stuff. Social media, you can get registered for us on all those. If you like what you hear, you can click the like and subscribe buttons. And if there's any topics you want to hear, then pop it into the chat, and we would love to hear from you. Thanks, everyone, and we'll see everyone next week.